In the next few minutes, I would explain few aspects of corporate restructuring. It aims at improving the competitive position of an individual business and maximizing its contribution to corporate objectives. Corporate restructuring is aimed at achieving growth, maintaining economic stability, reducing dependency on other businesses, complying with new government policies, becoming more globally competitive, and or receiving access to the newest technology. Now, there are several reasons of restructuring. There are scenarios of mergers and acquisitions, downsizing, new technology, business direction, employee satisfaction is to be focused, tax efficiency need to be achieved, and its challenges also will include talent gap, leader involvement, employee communication, etc. Advantages of restructuring involves decreased cost and increased efficiency, reduced risk, new investment opportunities, and also to resolve shareholder disputes. The main types of corporate reorganization includes merger and acquisition, corporate buyout, corporate takeover, recapitalization, divestiture. Divestiture has got further divisions such as spin-offs and split-offs. Restructuring also will have different types such as legal in nature, for turnaround purposes or for cost-cutting purposes, repositioning, spin-off, divestment, etc. Methods of corporate restructuring involves joint venture, sell-off and spin-off, divestiture, equity carve-out, leveraged buyout, management buyout, master limited partnership, extra, which we will see subsequently. Now, split off is where the part of a company or a division is taken out and shareholders have stock in the subsidiary or the new company in exchange for the parent company stock. In split off, the existing shareholders can't keep shares in the parent company if they are opting for the new company or the subsidiary. But in case of spin-off, they can keep both. This advantage is there. And when you talk about split up, it means existing company splitting up into two new companies, and in that process, the existing company disappears or dissolves. Example, restructuring of Andhra Pradesh State Electricity Board, which was split up in 1999 into two separate companies called AP GNCO and AP Transco. Spin-off, I already told you about. And in case of a joint venture, what is happening is two companies come together and agree to provide certain resources towards the achievement of a particular common business goal. Example, DCM Group and Daewoo Motors entered into a joint venture to manufacture automobiles in India. Similarly, you must have heard of other similar projects like Hero Honda, Maruti Gypsy, etc. Now, the needs for undertaking corporate restructuring we have already looked at, like for example, to focus on basic strengths, operational synergy, extra, consolidation and economies of scale, revival and rehabilitation of sick unit is another thing, acquiring constant supply of raw materials. So in that case, what for raw materials, you will look for backward integration, then supply chain, or access to scientific research and technological related. Capital restructuring, combination of loan and equity funds. or being in par with the competitors. Equity carve-out is another form of divestiture in which part of a percentage of the existing shares are given off through an IPO, so that management control is still there in the equity carved out subsidiary or company. A demerger is another form in which the entity's business operations are segregated into one or more components. It is the converse of a merger or acquisition. Motivations for sell-off are to raise capital, curtail losses, strategic realignment, efficiency gain, etc. Divestiture strategy is the way to go when a particular business line doesn't perform to expectations and becomes a liability instead of an asset. Yeah, divestiture or divestment involves a company selling off a portion of its assets, often to improve company value and obtain higher efficiency. When a company creates a new independent company by selling or distributing new shares of its existing business, this is called spin-off. Spin-off, split-off, split-up, all this I have already discussed. Divestiture is when a company or government disposes of all or some of its assets by selling, exchanging, closing them down, or through bankruptcy. It could be partial or full disposal in nature. Divestiture can include selling intellectual property rights, corporate acquisitions and mergers, court-ordered divestments, etc. Turnaround strategies for business in crisis include divestitures, which involve a sale, spin-off, or liquidation of a business unit, line, or subsidiary. Sell-off occurs when a large volume of securities are sold in a short period of time, causing the price of a security to fall in rapid succession. Selling a part of the firm by any one of the means like sale, liquidation, spin-off, extra is called sell-off. Now, leveraged buyout is one type of it in which large amount of leverage or debt is taken in order to buy an existing company. Example, acquisition of Chorus by Tata Steel was through large amount of leverage or debt. Leveraged buyout scenarios can be repackaging plan, split up, portfolio plan, and savior plan. It could also involve buying a public company through leveraged loans, making it private, repackaging it, then selling its shares through an initial public offering. Leveraged buyout is one aspect of it, and there is another called management buyout, which is a form of leverage buyout when the existing management of a business purchases it from its current owners. The managers themselves, when they buy, then they have got more knowledge of the company, they could manage it better, and they know the lacunae problems, they could address them. The management puts up its own money to gain control as shareholders in the management buyout. Whereas in leveraged buyout, an outsider arranges debts to gain control of a company. And in equity carve-out, what is happening is the parent company does not sell all of its shares in the subsidiary company, only some portion, so that the control is maintained. In management buyout, there are many advantages and disadvantages. Management buyouts are simple and easy to arrange. Confidentiality can be maintained because managers were already inside working in the company. There are high chances of success because managers already know the working operational aspects of the company, its pitfalls. There are no difficulties of raising funds, lack of business ownership experience is not there. And another aspect is a master limited partnership, which is a company organized as a publicly traded partnership. It combines the private partnerships tax advantages with a stocks liquidity. It has got two types of partners called general partners and who manage the day-to-day activities of operations, and there are limited partners who are only investors. And in master limited partnership, there are no so-called workers. There, the cash flow is distributed among the partners, and there are only income taxes. There are no corporate taxes. These are the advantages of master limited partnership. But one constraint is that they could only invest in properties or natural resources and energy fields like that. And mostly not seen much in India, mostly abroad in the US and such places. Employee stock option plan encourages employees to give their all as the company's success translate into financial rewards. So what is done is stock option is given to the companies. It's an employee benefit plan which offers employees an ownership interest in the organization. It is issued as direct stock, profit sharing plans or bonuses, and the employer has the sole discretion in deciding who could avail of these options. It is normally used for departing owners of successful closely held companies to motivate and reward employees or to take advantages of incentives to borrow money for acquiring new assets in pre-tax dollars. We have also got limited liability partnership. So it's a body corporate formed and incorporated under the Limited Liability Partnership Act 2008. It's a legally separated entity from that of its partner. Some or all partners have a form of limited liability similar to that of the shareholders. This is different from partnership in the sense that in partnership, the liability on all partners are equal and unlimited, whereas in limited liability partnership, the liabilities are limited. If one partner carries out a fraud or a scam, that damage is limited to that partner. That liability of paying back or making good is limited to that particular partner only. It doesn't go on to the others, unlike in case of a normal partnership. So that's all which I wanted to